Good evening to everyone. I am Christos, and today we will explore some common mistakes we make as novice investors, as well as an investment strategy that can help us avoid each and every one of them. Because let's admit it, we all make mistakes, especially in investing. And when we're beginners, these mistakes can cost us dearly. Fortunately, in today's video, we will see together how we can avoid them and smoothly build our financial future. Let's delve into the details together. Before we move forward, if my videos have helped you to get your finances in order and you want to start investing successfully, you can set up your investing account via the links in the description. This way, you can make sure that you're using a reliable platform and you'll be also supporting this channel directly without any expenses. Plus, don't forget to give this video a like and leave a comment. It really helps out with the YouTube algorithm. Of course, if you haven't done it already, subscribe to the channel and hit the bell icon to be notified when I upload videos. In order to be on the same page, let's get the standard disclaimer out of the way. I am not an investment or legal advisor. All opinions expressed in this video and on this channel in general are solely my own. They are meant to entertain you. Do not take investment or legal advice from a person on the internet. Always do your own research. As mentioned at the beginning, all of us made mistakes in our initial investment steps. Everyone. And it cost us in at least one of two ways. Either we lost money or we wasted time. Or both. However, time is clearly more crucial when it comes to investments. Some will say that's the cost of learning. And yes, to some extent, I agree. If we're mature, we learn from our mistakes and become better. But if we're wise, we learn from the mistakes of others. We put our ego aside and say, they might know something more than I do. So, let's look at some of the most frequent mistakes we make in our investments, especially as beginners. And of course, how to avoid them. Let's get started. We don't diversify our investments. One of the most common investment mistakes is the lack of diversification in a portfolio. So, we're investing all our money in one or two stocks that we like. You see, when all our money is in one or two stocks, no matter how good they are, there's a massive risk that an unforeseen event, black swan event, can wipe out our investments. Diversification, that is, spreading our money across various investments, is crucial. It helps to distribute the risk, reducing the impact, as we say, of a single bad investment on our portfolio. For instance, if we've invested in just two stocks and one drops by 50%, then this decline will reduce our portfolio by 25%. We'd lose 1/4 of our investments due to just one poor investment. On the other hand, if we had 500 stocks and 50 of them fell by 80%, then our portfolio would drop by 10%. See the difference? It took 50 companies losing 80% of their value for us to lose 10%. An unlikely scenario. Therefore, investments without proper diversification risk significant losses, while diversified portfolios, as we say, are more likely to survive in the long term. Wait a minute, Christos, I hear you say. Aren't you always advocating to invest only in VUAA? Where's the diversification? Well, it's within the VUAA itself. You see, the VUAA, which by the way is tax-free, tracks the S&P 500. So, it invests in the 500 largest American companies. 500! How much more diversification could we want? Well, we should also have stocks from other countries, not just America. Know thyself. The other extreme to little diversification is excessive diversification. We, the simple investors who just want to build a prosperous financial future for ourselves and our children, have no reason to get involved with these. The American stock market is by far the most resilient, safe, and profitable. We don't need anything else. So put all your investments into VUAA and continue to do so every month until you're in your early 50s, and you'll come out ahead. Very much ahead. And if you want a step-by-step guide on exactly how to invest in VUAA, the process is incredibly straightforward. Sign up with Freedom24 through the link in the description for one free share. Go to the web terminal, type VUAA, select buy, and just like that, you've got it. Moving on. Mistake number 2. Investing emotionally. Emotional investing is another common pitfall. We shouldn't make decisions based on our feelings. We need to do objective analysis. The so-called FOMO, which you've perhaps heard many times, fear of missing out, can lead us to catastrophic decisions. Oh, Nvidia skyrocketed, everyone's buying it, I shouldn't miss out. It's the silliest thing. Take a step back. Congratulate those who saw it and benefited from the trend, and see how you could have spotted it too, so you can identify similar opportunities in the future. Not to just follow the crowd on an opportunity that has long passed. To avoid emotional investments, it's essential to have a well-defined investment strategy and stick to it no matter what happens in the market. Do you want a simple and clear investment strategy that we can all follow regardless of what the markets are doing? DCA, dollar cost averaging. Once we've chosen a diversified investment vehicle, for us, it's VUAA. All we need to do is each month set aside as much money as we can and invest in it, whether the markets are up or down. If the stock market has fallen, we rejoice because we can buy even cheaper the next month. If it has risen, well, I don't need to say why we'd be happy if the stock market has risen. The key here is to understand that no matter what the markets do, our investment strategy is simple, specific, and consistent. In this way, we avoid emotional reactions and ensure the market's overall long-term performance. Now, on to mistake number 3, trying to predict the market. Attempting to find the right moment to buy or sell a share, so-called timing the market, is another common mistake many of us make, especially in the beginning. Accurately predicting market movements, whether it will go up, down, or move in cycles, is impossible, and our attempt to do so will only lead to losses. But technical analysis says, no, I don't want to hear that here. It says nothing. We, the average investors, should always keep one thing in mind. Timing the market beats timing the market. That is, having our money invested for a longer period is much more important than investing it with very high returns for a shorter time. Why then don't we invest with high returns for a long period? Because we aren't Warren Buffett. Let's be realistic. Mistake number 4, we lack clear goals. The absence of defined investment objectives can lead to poor investment decisions. It's essential to have specific, measurable, and achievable goals for our investments. Meaning, we should know if we are investing with the aim to retire early, buy a home, or finance a child's education. Broadly speaking, on this channel, we primarily discuss one main investment goal: early self-retirement. In other words, to build enough investments so we can live off the passive income they provide. Yes, okay, but how is this done in practice, you might now ask? Following the strategy we've outlined so far, throughout our investing journey, we keep putting as much money as we can into VUAA. This ETF has a feature called accumulating. That is, it automatically reinvests dividends to grow faster. Therefore, it's the ideal investment vehicle to increase our wealth. When we decide to stop working and live off our investments, we'll have 2 options. Option 1, we sell 4% of our investments every year and live off that income. So, if we've accumulated 1 million in investments, we sell 40,000 annually, giving us a monthly income of nearly 3,500. But you didn't factor in taxes, it's tax-free. All our income from VUAA is tax-free. But won't our capital eventually run out, one might wonder? No, because VUAA grows by an average of 10% annually. So, we both live on 40,000 tax-free per year, and our capital continues to grow at about 6% annually. Amazing. We also have option 2. If we've saved even more money, we can sell all of our VUAA and convert it to VUSA. This is the exact same ETF, with the only difference being that VUSA does not reinvest dividends but gives them to us. So, if we've accumulated 3 million and convert it all to VUSA, then it will provide us dividends of about 35,000 annually. That's 3,000 a month, without selling anything, and with our capital growing by 8% annually, to leave even more for future generations. Of course, VUSA is also 100% tax-free. That's all for today. We looked at the 4 basic investment mistakes we all make, especially as beginner investors. And we didn't just theorize, we saw practically how we can avoid each one. Let's therefore look to our financial future with optimism. As always, if my videos have helped you to get your finances in order and you want to start investing successfully, you can create your investment account through the links you will find in the description. This way you are sure that you are using a reliable platform and actively supporting this channel for free. Thank you so much for watching this video. I hope it helped, and I'll see you in the next one.